Hey everyone. Cybersecurity stocks are one of the most interesting stocks in the markets today. The industry has been growing rapidly and it has another decade or two of growth remaining as more and more companies require cybersecurity. It's becoming more of a need rather than a nice to have. So, in this video, I'm going to compare two of the top cybersecurity stocks in the market today, Palo Alto Networks and Fortinet, and answer which one is the better buy. So, let's jump into this comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first thing I'm going to compare these two on is revenue growth. And you could see for the trailing 12-month period going all the way back to 2015, Palo Alto Networks has demonstrated better growth. It's up to 7.527 billion in revenue compared to 5.3 billion with Fortinet. Of course, Palo Alto Networks has been more aggressive in acquisitions and in marketing strategy. It's been more willing to sacrifice profitability for revenue growth. And in the latest quarter, that was further demonstrated by Palo Alto Networks, which is suggesting it's entering into some kind of price war to try and attract customers. Now, Palo Alto Networks said something like, we're going to give very generous terms to clients to come with us and add incremental service with us. So we're going to compete against those companies that are trying to retain customers, those companies specifically that only have one solution. We want them to come to Palo Alto Networks and sign up to two or more solutions because those customers offer us great value. So Palo Alto Networks forecasting slowing billings growth in the next quarter. I believe as a result of this strategy, they're going to give a lot more free trials, a lot more incentives to get customers to try Palo Alto Network service. And that's going to have ripple effects industry wide. It's only beginning, in my opinion. So I'm looking at this industry more closely now following these decisions by Palo Alto Networks in its latest quarterly update. Fortinet, meanwhile, growing nicely, although not as aggressively as Palo Alto Networks, not taking those levels of steps to try and retain customers, to try and gain access to new customers. Palo Alto Networks is really taking an aggressive stance here, one that I haven't really seen in the cybersecurity industry in recent months and recent quarters. The next thing I wanted to compare these two on is their operating profit margin over a trailing 12-month period. And you can see Fortinet's supremacy in this metric nearly tripled that of Palo Alto Networks, and it has consistently outperformed Palo Alto Networks in this metric going back all the way to 2015. 23.3% in the most recent trailing 12-month period compared to 7.98% for Palo Alto Networks. The next thing I wanted to compare these two on is cash flow from operations to sales, but I want you to get a better understanding of this metric first. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you've seen details surrounding this metric, you can see why there's such a difference here in Palo Alto and Fortinet with their operating profit and cash flow from operations. They're much closer in this metric, with Palo Alto Networks in the slight lead here at 40.68%. Although I wouldn't be surprised, given Palo Alto's strategy going forward, if Fortinet supplants Palo Alto Networks again, as it has done in the past in brief moments. So I'm going to be watching this metric closely as well as it evolves on the changing competitive environment. I also want you to understand how average shares outstanding impacts investors. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. And so you can see here, Fortinet has been decreasing its share count from a little over 850 million all the way down to 772 million. So they've been buying back shares, reducing share count, while Palo Alto Networks has been doing the opposite. They've been diluting shareholders. A little over 200 million shares outstanding in 2015, all the way up to 357.5 million. This is a result of some of those acquisitions they've made being in stock rather than in cash, and so that dilutes shareholders, as you can see here with Palo Alto Networks. And finally, I wanted to compare these two on valuation. According to the forward PE ratio, Palo Alto Networks is more expensive at a forward PE of 48.34 compared to that of Fortinet at 36.73. So all things being considered, given that Fortinet has the better operating profit margin, given that Palo Alto's networks strategy is more aggressive, more sacrificing profitability in favor of growth, and the lower valuation, I'm going to choose Fortinet here as the better cybersecurity stock to buy today. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.